Range has exploded. Volatility has exploded. A lot of it is due to the tariff uncertainty. Uncertainty what the Fed is going to do with interest rates. Is there a global slowdown? For the first time in a long time, fear is being priced into this market. Are the traditional option strategies that you have used in the past starting to fail? If you are part of that camp, you're not alone. We've talked to so many traders here over the past number of weeks that have really struggled to start the year because of the changing market conditions. What worked really well last year, not working so well now. What I want to talk about in today's video is how you can adjust and adapt to these changing conditions, knowing that there's a very good chance that these conditions are here to stay. I don't believe we're heading back to the one-way grind higher. There's a massive opportunity here as long as you take the right steps to prepare yourself for that opportunity. So let's take a look at how things have changed. If I take a look at the daily chart of the S&P 500 ETF, this is symbol SPY. If we go back to last year, it was a historic bull run. Right? I mean, we were moving higher for most of the year, very few dips. We actually went long stretches without any dips, and when we did get them, they were bought up almost immediately. Anything that you did on the bullish side worked well last year. Buying call options, buying stock, selling covered calls, selling naked puts, all of them worked really, really well. So far this year, very different story. A lot of those strategies are struggling. So now you have a decision to make. Do you continue to use them exclusively, just expecting we're going to get back into that bullish environment? Or do you make an adjustment and better prepare yourself for both bullish and bearish markets? That's the key here, because look how things have changed. Look at the ATR. For most of last year, the average true range was between 5 and 6. Compare that. Let's go over to the right edge of the chart. Compare that. Just over the past number of weeks, we have seen the ATR explode to 10 initially and upwards of 20 here over the past 2 weeks. That's a big, big change. Range has exploded. Volatility has exploded. A lot of it is due to the tariff uncertainty. Uncertainty what the Fed is going to do with interest rates. Is there a global slowdown? For the first time in a long time, fear is being priced into this market. So our opinion is that this type of environment is here to stay. We're going to see big swings back and forth. I don't expect the market to crash, nor do I expect us to zoom right back up to all-time highs. I think we're going to see movement back and forth. As an active trader, I get excited about that. I'm not dependent on a never-ending bull market. If I can position myself properly, I can benefit from movement in both directions. And I'm going to show you how I do that here over the next few minutes. So let's go over to our trading charts, and let's go over to the 130-minute chart. We're going to start out with a chart of GLD. This is the gold ETF. Now notice I've got different colored dots here on the chart. I'm going to put your focus to these green dots right here. I've got my entry dot right here, 2 target levels up above, and I've got my stop dots down below. We have a very specific set of criteria that we look for on every trade that we take. And that criteria is programmed into the trade calculator. The reason this is important is it gives me a rule set that I can stay disciplined to. So many approaches out there will give you a rule set, but there's a lot of discretion involved. Without these setups on the charts, it's really easy to say, well, I would have done this and I would have done that. In this case, it's either a setup or it's not. I can go back and look and see, where did I get in? Where did I get out? All these dots plot for me in real time. It gives me a roadmap that I can follow. So in this case, when we had our bullish setup hit, the entry point touched, we came in, we bought the 288 calls, $806 per contract, came up, hit first target, allowed us to reduce some risk, move the stop, eventually hit that second target. And at that point, there's no guesswork involved. There's no discretionary decision. Once that target's hit, I'm out. I booked my profit, booked a $709 profit, 87% return. It gives me a roadmap which allows me to limit the emotional decisions. If you're like me, I'm terrible at making discretionary decisions when it comes to my trading. I need a rule set that guides me on every decision that I make. This system allows me to do that. Now, here's the neat part. If we take a look at my data window on the right-hand side. When I go back over and click on those green dots, you're going to see LE, which is my long entry, LX, which is my stop, target 1 and target 2. Notice the difference between my entry and my target 2. There's an $8 difference there between entry and target. Now compare that. Let's just go back a couple of months. Okay, let's just go back to an earlier setup. And if I go back to this long setup right here, there's a $5 difference between my LE and my T2. I'm going for a $5 target there. If I go back to March, I'm just showing you a series of trades here. In this case, there's a $3 difference between my entry and my target 2. The system is dynamic, and that's the most important piece here. So did our system break down when we transitioned from last year to this year? It didn't. Has it broken down the last couple of weeks with this volatility explosion that we've seen? It hasn't. The system is looking at market conditions. It's looking at the range, and it's going to fine tune the setups automatically to plot those entries, the targets, the stops based on market conditions. As range expands, we can go for the larger winners. When range contracts, I can go for the smaller profits. I'm taking what the market's giving us instead of just looking at an arbitrary target number and saying, hey, I want to book 100% return on every trade that I take. Well, I would love that, but the market doesn't always make it conducive. It's not always that kind to us. We want to use a system that's dynamic so that we can react to anything the market throws our way. Bullish environment, bearish environment, volatile environment, slow environment, doesn't matter. Do I have to make any adjustments here? Do I have to turn any dials when market conditions change? I don't. The system is built to do that automatically. It really reduces that stress level, and it allows me to trade with much more confidence. When I went over to this GLD trade and I hit that target, was there any guesswork involved saying, well, maybe I should hold on. Maybe there's a bigger move coming. There's not. I know that target is fine-tuned to current conditions. That's going to maximize my profit potential while reducing my risk over time. That really allows me to trade with more confidence. And that's the missing piece for a lot of traders. I know it was for me. This was a game changer for me taking this type of an approach. Now, I've also had some questions from people asking, well, you're talking about buying options here, but what happens when volatility does get super high? Options are expensive. Or what happens if you don't want to be as aggressive? Maybe you're a little less certain of markets making a directional move. What can you do? Well, let's go over to another chart. Let's switch this over to Walmart. Same 130-minute chart. You're still seeing the dots on my chart, but now this is the latest trade that we took here on Walmart. If you see these magenta dots, now they're on the downside. Entry, target 1, target 2, stop up above. Now I'm looking at a bearish trade. I don't care if the market moves up or down. Does not matter to us. If we're in a bull market, great. Bear market, that's fine too. If we're in a more of a neutral environment, there's always something I can do, because with options, we're not backed into a corner. We don't have to just buy calls and puts expecting the market to move. I can take a more forgiving strategy. So when I had this bearish trade, could I have just come in and bought a long put? Sure. But there's two concerns that I had on this one. Number one, the options were pretty expensive. Volatility is high. Options are pricey right now. I also know that we're coming off of a stretch where we've had big moves in both directions. I was a little less confident that a big move was coming, because then oftentimes when you're coming off of a big move, in this case multiple big moves, the markets have to digest that movement. Oftentimes it'll lead to a period of consolidation in the near term. I still need to respect the system. I still need to take a bearish trade, but what can I do to be more conservative? So what we did in this case, we came in and we sold the 97.99 call spread. All that means is I'm trading two options at the same time. It's not overly complex. It's not ultra risky. It's actually tying up less capital than the long option. It's a safer position because it gives us multiple ways of making money. If I buy a long put, I need that stock to move to the downside, and it has to do so quickly. With this strategy, I give myself 5 ways of making money. Up, down, or sideways. I'm okay in all 3 directional scenarios as long as price stays below 97. I also make money from volatility decreasing and from time decay adding up. I've got multiple paths that I can follow on this trade to make money. So in this case, you can see, has it been a clean move to the downside? It hasn't been. It's been pretty choppy. But yet we have already closed out of this trade. We collected $63 per spread, tied up $137 of our capital per spread. We closed out the very next day, booked a $32 profit per spread. That's a 23% return on my capital from a nothing move. From a move where if all you're doing is buying options, that can get frustrating. Because now you're saying, where's the movement? I'm just spinning my wheels. But instead, I'm booking a 23% return, $64 a profit, risking just $500 per trade from a move that typically gets a lot of traders in trouble. Mixing up your markets, mixing up your trade types, it makes all the difference in the world right now. Will there be a time in the near future where we get those big moves again? Certainly. We are definitely taking long calls and long puts right now, but we're also mixing in other strategies. I want to have that diversification. That's going to help with my consistency. It's going to help with my performance over time. And if you're not doing that, you're really missing out. It really reduces the stress level drastically. When we talk about diversification, it's not just in your markets. That's a big part of it. I love to trade the tech stocks, but I also like to trade the gold ETF. I like to trade Walmart. I like to trade some long options. I like to trade the credit spreads. The more layers of diversification, the more consistent your results will be. Now, if you're looking at that saying, okay, I'm intrigued, Mike, but how do I get there? First of all, you need that system in place. You need that rule set. So you're not just basing your decisions off of discretionary decisions, right? You're not just basing it off of a hunch or based on what you think or hope should happen. You're basing it off of numbers and statistics. The system that I'm showing you here today, we're going to be holding a webinar next week where I'm going to walk it through more detail on how the trades are structured, what's going into these trades, how do we find them, how do we manage them. All you have to do is click on the link in the video description below and we'll get you a spot reserved in that webinar so I can take more time to walk you through how you can gain access to this system and really start to stack the deck in your favor. All right, if you have any questions on the video today, feel free to post a comment on the video or you can email us directly, info@netpicks.com. We'd be more than willing to reach out and help with any questions you might have. So if you are struggling in this market, if you're looking for more consistency, we would love to help you with these tools. All right, so I'm going to wrap this video up here. I'll be back with you guys over the next few days with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.